All right, ladies and gentlemen, boys and girls, it is Tuesday, and we are excited for another edition of the Tuesday annuity training, the advanced market training. And we have a very special guest. Leslie's excited. We got people yelling. I don't know if that was for me, but we're going to take it. But we have a very special guest with us today, Pat Schmidt, who is heading up our annuity advanced market team over there. And Pat has a lot of experience. If you've not had the pleasure of meeting Pat, speaking with Pat, not a lot of guys can say that they played minor league baseball, they know their finance stuff, and that they look amazing in an elf suit. But Pat can claim all three. And so he's pulled that off. So, ladies and gentlemen, without further ado, Mr. Pat Schmidt.
Man, I don't know if that's the triple play I was shooting for as an 18-year-old kid when I was thinking what the career would look like, but I guess I hit them. I don't know what the fourth one is. Cover all my bases, but it is good to spend time with everybody this morning. And I got big shoes to fill here on this training call. Obviously, everybody is used to David Allen, and he does just a phenomenal job in this capacity. I just want to make sure I make mention. David, when I talked to him again last night, he was traveling back from Idaho back to California to spend time with family. So just asked to keep him and his family in his thoughts and prayers. So he's focusing in on them right now, and which is where he should be. So just want to make mention of that. And but happy to jump in. There's some fun things I want to talk about with specifically with annuities today. So I'm going to do a little share screen. Let's pull this off here. Hopefully that's showing up on everybody's got a thumbs up from Dallas. So at least Dallas got it here. But I had the opportunity this past weekend, for those who were able to be there. Fantastic. I know they're going to put together, there's probably a lots to edit. So whenever they get all things edited and get that distributed, but was in Louisville this past Saturday for the training. I thought it'd be great to drill down on one of the subject areas that we talked about during that training session and explore that a little bit more. And that's really with obviously the focus on annuities, but utilizing annuities as a winning replacement opportunity. And what I mean by that is you're going to come across prospects who have an existing annuity, maybe underperforming, and maybe a variable or a buffer type product that actually can go backwards in value. And that same prospect may have hesitation because of surrender fees or knowing that they have another few years left in that. We're going to talk about ways that you can come alongside that person right now and be able to upgrade them and position to be able to get them out of that annuity sooner than later. And so you can put them in a better situation. So being able to bring true value right away. And then the second one, you're certainly going to meet with folks that are going to be complaining about the market downturn and how much that's impacted their retirement account. So we're going to talk about some bonus products, some bonus features in the fixed index annuity space that you can talk about how you're going to win back some of those losses right away. And again, make sure that some of those uncertainties of the future don't happen again to those same accounts. So that's where I want to drill down and spend some time on this morning. And as we do that, I thought before we get into some of that, obviously just kind of stepping back and talking about the landscape of annuities in general, so you can have a feel of some of the different statements and some of the different accounts that your prospective clients, those families that you're sitting down with at the kitchen table are telling you about. And I think it starts with the question is, what does your prospective client think about annuities? And I believe that that's important. And I believe that it's also important. I know David spends time on this, is making sure that you're pulling out early in the conversations what their experiences are. What do they think about when they think about annuities? And the unfortunate truth out there is that you have a $1 trillion mutual fund and investment industry that really controls the narrative on the internet and puts all annuities in the same bad light. And that's just not the case. There's all kinds of annuities. There's good annuities, there's bad annuities, and there's a bunch in between. But you will find that when people think of annuities, if they've never owned one, the first thing that they often think of, the first type, is what's probably immediate income annuity, or you also hear this as a SPIA, a single premium immediate annuity. These are the annuities that go all the way back to the Roman Empire, where nowadays you give your money to the insurance company in an immediate annuity, and they're going to start paying you monthly payments or periodic payments until you die. Obviously, as you all know, that you can structure those in a variety of different ways. Why I'm telling you this is that a lot of people think of this type of an annuity as being the only type of annuity, and that it's like a pension. And their fear is, all right, if I die after receiving 3 payments, the insurance company gets to keep my money. So it's important that you disarm that thought process, that you disarm that early on and talk about, hey, there's a lot of different types of annuities. That's one of them, but there's some really safe ones out there that are becoming more and more popular that people are using as a complement to their retirement plan. There's fixed annuities. You'll hear these also called MIGAs, or multi-year guarantee annuity. Making comparisons to how a CD works is how I often position a fixed annuity, right? People know how CDs work. They know they can get those to a bank and they can be a certain period of time. And if you have a 2-year CD, it's going to pay you this percentage annual rate during the 24-month period. Well, you can do the same thing with a multi-year guarantee annuity, where it's just going to pay you a specific rate. But oh, by the way, often those rates are significantly higher, but you also can get some great tax advantages because the CD interest is taxable each and every year, where the MIGA, that fixed annuity, is tax deferred. So that 4 or 5% that you might be getting annually, you're not paying taxes on that until the end of the term. Or by the way, you can also then move that as a 1035 exchange and continue to tax defer the interest earnings on that piece. So that can be a really good CD replacement, can also be a really good part of the overall plan. I'm going to spend just a second on these next 2 types, which are variable annuities, buffer index annuities. I'm just sharing these with you because you're going to come across statements, you're going to come across people who are complaining about having annuities that can lose money, and that may be their experience. Well, these types of annuities can both go backwards in value. So a variable annuity, I'm not a big fan. I have my securities license, so I can do all things in the financial space. You'll not get me ever presenting a variable annuity personally. I believe because they can go backwards in value, and because of the high internal cost of ownership to the client on this, I just don't see them as a very good fit. You're talking about internal fees and costs that can be upwards of 5 to 6% a year, which means that the client's got to earn 5 or 6% growth just to break even in those strategies. The buffer index annuity, it's not as popular. Keep in mind, the variable annuity is older than the fixed and the fixed index annuity. So the variable annuity has been around for a while. You'll see a bunch of those that were purchased in the mid part of the 2000s, 2005, 2006. And those, of course, got beat up pretty hard by the recession that we had in 2000, 2008. A buffer index annuity can also go backwards in value. And I'm going to spend obviously more time on the fixed index annuity, but just know that a buffer index annuity, instead of the floor being 0, you could set the floor as losing 10 or 20% in effort to gain more on the upside. But those can certainly go below 0. So somebody who owns a buffer index annuity could lose money in that. But it will use an index like the S&P 500 as a way to tribute gains. But again, it can also go backwards in value, and it locks in those losses too. So what do I like? I love the fixed index annuity. These are more the newer types of annuity products that are out there. You are going to find that most people are unfamiliar with how these work. So I want to make sure, just in stepping back and just providing just a little bit of an overview again on how these work, so you can best position these against these other types of annuities that are out there. But more importantly, be mindful of some of the poor experiences that those families have had and how they have lost money, how you can utilize the fixed index annuity to be able to come alongside them and put your family in a better situation. So again, I love these, the flexibility that they provide. You can use these for accumulation. You can use them for income. You can tie in home health care and long-term care benefits a part of these. These can provide a solution or a cure to a lot of those challenges or roadblocks that retirees face. But the number one reason that I like them is safety. Fixed index annuities can't go backwards. If you're not using any riders or fees, or there's no cost, you can really articulate these in a very simple, digestible way for your client to understand. And if you can provide clarity and simplification, you're going to build trust. And as you can build trust, you're going to take that person from a transactional client to somebody who can be an ambassador for you, somebody that's going to tell the person they sit next to at church, or who's in their bowling league, or they play golf with once a week, about what you do for them and how you have now put confidence or brought confidence to their planning. So I want to step back as I talk about replacement. When I think of replacement, I'm thinking about somebody who still has an annuity. Maybe it's a variable, maybe it's in a fixed or a fixed index annuity, but you can put them in a better situation. So first and foremost, it's important to understand that the annuity that they may be in currently may still be up against a surrender schedule. That surrender schedule could be 2 years, 3 years, 7 years, 10 years or more. Let me just give you a sample one. So pull this one. And if you have somebody who's maybe in their first 12 months of that annuity, maybe that surrender charge is 8.5%. Maybe after the first 12 months into year one, it's 7.5 and then 6.5. This one has a 7-year schedule before it's entirely surrender free. You don't not have to know the surrender schedule. You don't have to memorize these for all the carriers and all the products, nor do you need to know even the withdrawal amount that is available each year. That's what you have our retirement team for. We have access to tools and the knowledge and expertise in all of these areas where we can be able to pick and be able to help you come alongside you to help you create a story on your opportunities and maybe even present to you and give you an understanding on where some of your challenges are. But what you need to know is that we are in one of the best replacement opportunities that we have ever been in as having our annuity license. What I mean by that is we have a ton of fixed index annuities that have premium bonuses to them. I often will say this when I'm sitting down with a prospective client. You remember the good old days when banks were giving away free money for opening up checking accounts or savings accounts, and I'll get the little old lady that talks about how she got like a toaster oven a couple decades ago when she opened up a savings account. Somebody also mentioned how they got a free teddy bear, but they remember when banks used to give these types of incentives for opening up new accounts. Well, in many ways, you can position the insurance companies. They're doing the exact same thing here, where they're providing incentives or bonuses for people who are opening up new accounts. So meaning if you were meeting with somebody who had $100,000, maybe it's just maybe it's an inheritance, maybe it's just money that's from a sold property or savings or checking or money market, just lazy money that's not making any interest anywhere. You can put them in a bonus product. These bonuses are all over the map. They can be 6%, 8%, 10%, 12%. There's different types of bonuses that come on like death benefits and income. But if we're thinking about premium, I'm talking about the real money that's added to your account value right away. One of the more popular products out there right now in this space is with Security Benefit. And Security Benefit has a 12% bonus. So that same prospective client who has $100,000, they put it with you with Security Benefit, they get a 12% bonus. Day one, their accumulation, their account value is now $112,000. And oh, by the way, that $12,000 that they added day one is also market protected. That's not subject to any type of market flexibility with a fixed index annuity as well. I'm giving you that example because I hope you start connecting the dots. Well, if you have that prospective clients who, let's say that they're in an annuity in year 2, your surrender schedule example there, and let's say it's 6.5%, and maybe they got a strategy that's maybe it's in a fixed index annuity that is only has a cap of say 3 or 4%. Well, now we can come alongside them, we can bonus them out of that. So now they're netting about 5.5% to the good guys on that annuity, washing away those surrender penalties, those surrender fees. And we can now put them in a strategy that has better annual interest potential. I do want to make sure I pause and tell you that every replacement carrier has some different suitability guidelines. Peace of mind knowing you do not have to memorize that. We have the expertise and all kinds of things with the carriers to be able to say, hey, listen, can't use this company or this company, but these 3 or 4 companies have a little more flexibility in terms of their suitability guidelines. They will absolutely take it. Maybe the bonus isn't quite as high on this, but you're still going to come out ahead for your client. And oh, by the way, instead of having the cap or the rate that they have now, they're now going to have a cap that is maybe 2 or 3 times higher. And even with some of those annuities that were purchased just 2 years ago, guys, 2 years ago, the caps were 4 to 4.5%. Well, because of the interest rates flying skyrocket high, we're now seeing caps 8, 9, 10, even higher on specific. So sometimes with that upfront bonus, maybe you get a little lower cap, but without the bonus or a lower bonus, you can get even a higher cap. So we can work with you, with your prospective client. We can be available to jump on the phone and talk through these things with you to make sure that you're making the best recommendation possible. But some really good replacement opportunities have presented themselves because of the way these bonuses are really high right now and with the allocations. So I do want to talk through just in terms of some easy ways that you can articulate how these fixed index strategies work. So now we've overcome, in talking with the bonus and be able to replace and either replace and totally eliminate that surrender fee or eliminate and come out more to the good guys. But let's talk about some of the allocation options. Me personally, I like to use the S&P 500 when I'm using a fixed index annuity. I believe for your client, they've heard of that index. You can simply tell them how the S&P 500 is just 500 largest U.S. companies that are publicly traded. But then I just walk them through a way to just really kind of simplify this. So let's say today's date is December 13th. So Mr. and Mrs. Prospect, let's say you're putting $100,000 into this strategy today. Well, what the company is going to do is they're going to look at the S&P value today, and then they're going to look at it on December 13th of next year. And they're going to look at the percentage increase or decrease as a way to be able to, or as a way to credit interest to that account. So what I mean by that is, let's say over the next 12 months, the market stays on a negative downturn. Maybe the market loses another 16%. Maybe it goes 2008 on us and loses closer to 40%. Peace of mind, Mr. and Mrs. Prospect, that 100,000 that you put in here, you don't lose a penny. With this type of strategy, you wouldn't get anything credited to the account, but you don't participate in any of those losses. So that 100,000 that would be going in today is still going to be $100,000 on this date next year. And you can use real numbers in terms of like how far it would go backward if they were actually in the market. That with 100,000 would almost be $60,000 if it experienced a 2008 recession economy. So now, because Mr. and Mrs. Prospect, you're not participating in any of the downside, the way the strategy works is they don't give you all of the upside. Otherwise, it would be the world's greatest investment. Nobody would own anything else but fixed index annuities, right? However, they will give you what's called a cap amount. The current cap on the strategy that I'm presenting to you has what's called a 10% cap. What that means is if over that same December 13th of today to December 13th of next year, if the market does 11% or 15% or higher, you're going to get the cap. So you're going to make 10%. Now, if the market goes up 4%, well, you're going to make 4%. So what I'm telling you, each and every year, you're guaranteed to make somewhere between 0 and 10%. How does that make you feel if you've now safeguarded your money? Pause, let them answer. I always found sometimes early in my career, I'd get too fast. But then one of the things I really like best about this strategy is, remember I talked about that bonus? So you got your 12%. Let's say that we add another $8,000 on this strategy for the first year. Now all of a sudden it's $120,000. Let's say then the market really takes that nosedive. Maybe it goes even worse than 2008. Well, Mr. and Mrs. Prospect, you still have $120,000 as part of this. So every year as you credit interest, think of that as a stair step. You've now stepped up the amount that's now safe, that's now guaranteed, that is now principal protected. I also want to take a minute too to talk about participation rates. So the cap strategy, easy to understand. If it goes higher than the cap, you get the cap. If it's lower than the cap, in between 0, you get that, but you never participate in any of the downside. I really like the participation rate gang too. So I want to talk about that with you. So here's how the participation rate works. And you don't participate in anything negative. It can never go backwards. So just like the cap strategy, your floor is 0. So you can use all the same examples. 2008 market literally lost 37% that year. Sleep easy at night. Your money is incredibly safe. I'll use a participation rate of 50%. So in my example here with you. So what that means is if the market goes up 10%, you're getting 50% of the 10%, or you're getting half of the positive growth. So if the market goes up, 18%, you're getting half of that. So your client would get 9. If the market goes up 30%, your prospect, your client is getting half of that. So they would get 15%. So they're getting half of whatever that market does in that same scenario of December 13th of this year to December 13th of next year. No participation, anything down. But as the market goes up, each and every year they're going to get half of that, and they're going to get those dollars in credit to their account. Same as the cap strategy, those dollars get locked in, safeguard each and every year as they get stepped up into it. So as you start to recognize how you can really craft a story with a great bonus replacement option, you can start to then walk them through how that S&P 500 can serve to their benefit without taking any losses. You can also then talk to that person who you might hear share with you about how much their retirement account has really suffered over the last 12 months. Maybe they've lost that 15% or that 16%, or maybe they were even a little more conservative and lost a little bit less than that. These bonus products can serve as a really great way to tell a story about, hey, what if we can win back those losses right away? And a number of these premium bonuses, they're not vested. They get added to the accumulation value right away. So you can win back, maybe not all of them, but you can win back a really good chunk of those losses, because now with your prospect who may be wanting to retire in the next 2, 3, 4 years, maybe even longer than that, they can't afford the setbacks. For those of you who may be newer to the industry and didn't meet with prospects from 2008 to 2012, there was a lot of people that had to delay their retirement because they were not positioned appropriately in 2008 and 2009. And it took them a significant amount of time to win back the earnings where they could be able to retire. You're able to do this. And oh, by the way, keep in mind that 2008 was about twice as bad as what we've experienced this year. People grew numb to that time in 2008, 2009, because we came off one of the best decades ever in the market. Not one of, the best decade ever in the market. So people grew numb. They forgot. Is that amnesia? They forgot about what can happen in the past. But this has rocked everybody. But you have to make sure that you're reminding them that this rocking that they're taking is nothing anywhere close to what a 2008 or even other times where the market has been a 30% loss or more. Year to date, we're down around 16%. That's not awful compared to where things have been historically. And it's on us to make sure that we're providing people that clarity. So just a really good story to be able to win back some of those losses. I know I see a couple of questions. I'm going to make sure I give time at the end to be able to come back and hit a few of those. Just want you to make sure you know that I'm not ignoring. So I definitely want to make sure I'm hitting those. I did want to share. For those of you who may have been able to part of the conversation last week, Brian had shared this. I put a little different format for you to see. So what I wanted to quickly do here before I get to some Q&A is on the left-hand side, you have 2000 to 2010. So you can see in the gray column, that's what the S&P 500 actually returned each of those years. So the negative and positive returns. So you can see if you had $100,000 that was actually mimicking the S&P 500, all of the gains, all of the losses, at the end of 2010, that $100,000 investor would have a little more than $104,000 by the end of that period. Now, that same investor, if they had $100,000 that they put in a fixed index annuity that was getting the 50% participation rate, notice you have those negative years where they didn't make anything, but they're getting 50% of the earnings in those positive years. That's somebody with that $100,000 would now have $166,000 at the end of that decade. Conversely, that person, 100,000, let's say they had the cap strategy. So let's use that 10% cap. Same thing, no losses are suffered in the negative years. If the earnings, for example, in 2005 were 4.9%, they get 4.9%. But you see there's a number of years in there where the S&P 500 grew larger than 10%. So they're getting a 10% cap. So at the end of 10 years, that investor had $178,000. So obviously one of the worst decades, but notice how you can talk to how money and the earnings that have happened over that really rough period of time because of locking in earnings in those positive years. Then I want to take us to kind of continuing that same format. Now let's bring that same $100,000 forward into this most recent decade. So from 2011, even ran it out to the year-to-date return. This is through the end of November, actually, was about negative 14.5%. But you can see that if you look from comparatively speaking, it wasn't until about 2017. So now 17 years in, somebody who's in the market with all the risk actually gets to the point where they eclipse somebody who was in a participation rate strategy. It wasn't until 2019, thereabouts, you started getting to the place where the person taking all the risk eclipsed the person being in a S&P 500 cap strategy. Now, keeping in mind, that's through one of the best decades. Again, not one of, the best decade in market history. And if you're going to ask folks about what their sentiment would be on where the market would go, if it would more closely replicate 2011 to 2020, or would it more closely replicate 2000 to 2010? I believe most people are going to lean to feeling it a little more like the latter, that we're going to see more turbulent times ahead. And so this is a powerful story, and make sure it's incredibly important to make sure people are feeling that. Because at the end of the day, the number one fear for people is running out of money in retirement. So what does the Impact Legacy Retirement Group want to do as we come alongside you? We want to make sure we're providing people clarity on where their money is coming from each and every month. We want to make sure we're arming them with strategies where their money cannot go backwards due to the market. We want to make sure we're arming them. We spent a good chunk of time this past Saturday on tax planning and the benefits and the long-term savings of making sure that we keep Uncle Sam away from those retirement accounts. We want to make sure we're evaluating ways where we can reduce those fees, reduce those annual costs that are happening each and every year. And then the last one, or not there's another one after this, I guess, but the number one reason people run out of money in retirement is not addressing long-term care, not having a plan in place. Annuities, life insurance, hybrid life insurance, or long-term care benefits, all of those and more can be really good components to put in place to make sure that the families you meet don't suffer these losses. And then one I have here, and this is what our Impact Legacy Retirement Group has in place and has continued to build, is making sure, here's why people run out of money. They don't have an investment, a tax plan, a healthcare, and an estate plan that all works together. And so we're bringing that to come alongside you, whether as you empower or elevate plans to our team. We want to make sure, I'll just share this quickly, is that we run a retirement score that says, all right, what's the percentage likelihood that you are going to run out of money in retirement? And as we meet with somebody, they may be a 50% when we first meet them. But by putting in the strategies and tools that they need, we can get them to the highest score possible, which is a 99%. And so you can see just the scope of services that we're providing that come alongside you. Our Elevate Retirement Review process really encapsulates 4 different parts. So our discovery meeting, our solutions meeting, our implementation, our ongoing review process. Why am I sharing that with you? Listen, we want to empower you and be a collaborator with you behind the scenes. But as you're coming across those challenging cases, or as you're maybe even newer to the industry, you have a resource, you have a team, and David Allen and myself and others as we continue to build our team that have hundreds, if not thousands, of meeting reps that would love the opportunity to be able to assist you, help you. You can sit and be a part of those meetings and learn from the conversations that are happening and having, so you can develop your skill set and talents to be able to run with those cases in the future. I do want to I want to pause. I want to make sure that a lot of talking. Let me get to some of these questions, but also feel free to unmute and fire away here as well. Many pitfalls if not structured properly. Glad we have pros to advise. That was a question. I appreciate the compliment. Steve Rice, does the surrender schedule present a non-suitable condition if we move them over to a new annuity? Steve, that's a great question. Some carriers are hands-off and are, I should say this, every carrier is very descriptive in terms of what that suitability is for replacement. The majority will say, as long as your client is made whole. So let's just use even numbers, and let's say there's a 6% penalty. If we move them, the new carrier wants to make sure that that person is not losing money in a transfer. So they want to see that they are at least becoming whole in that move. So if we use a 6% bonus or something greater to replace that penalty, the carriers almost always are great. Now there's some carriers like Equitrust, for example, that even though that they could, Equitrust has a 10% bonus product. So that 10% bonus is going to, move a lot of people out of a current surrender schedule. Equitrust won't take it until it's at least through the 3rd year. So every carrier is a little bit different. Some don't have any of those guidelines. They'll be willing to take it in the 13th month. And as long as you can document that it'll put the client in a better situation through better strategies or through erasing some of the market risks that they might have in that plan. That helps, Steve? What other questions that you may have? Fire away, gang.
All right, Pat, I've got a question on the participation rate, just to clarify. I know you went over some. Just let's say hypothetically, participation rate of 150%. I don't know if that's a thing or not. And I saw 145 on the IUL a few weeks back that I was looking at. So let's just say the 150% participation rate. That means if the market hits 20% and they've got a cap of 10, they would still get 150% up to that 10%.
They would get, yes, they would get 100% plus 50% more. So in that scenario, they would get 15% credit to that year. Yep. So you'll see some. Yeah, go ahead. I'm sorry.
That cap.
They will. So there are. You won't see it so much with the S&P 500 in doing the 100% or more, but with some of the other various indexes and strategies that are out there, or in the life insurance space, you'll actually see that. And I believe it's because they have like cost of insurance and some of those other things that are built into that help that out. But yeah, the IUL space, I know we're obviously focused on annuities today, but because of the interest rates and where caps are going, the IUL space is such a great story right now compared to what it was a couple of years ago when rates were in that 3% and 4%. I mean, things illustrate so much better now than they did just a few years ago.
So with annuities, what would be a good participation rate?
Yeah, if you're looking at the S&P 500 index, 50% is I've seen a lot to like that 40 to 50, 55%. So you're getting around half of the index returns without taking any losses added to it.
No risk, only the gains.
Correct. And I was just to maybe even expand on that a little bit more, Brad, is I was using like a 1-year lock-in. I actually like the 1-year lock-in because you can lock in those gains each and every year. But you could take a strategy and say, okay, we're not going to lock anything in for 2 years or even 5 years, and now it's kind of a floating number. You just run the risk of that one bad year happening in that last year before it locks in, and now you have to sit down with that client and say, well, unfortunately, the way the year ended here, this last year ended, we're not going to make any money, and that's just a tough story. So I actually will tell you that I prefer the 1-year lock-in. It's easier to say, the last 12 months were tough and we finished down, but great news. Now it's an annual reset. So now it's going to look at the next 12 months from this point to this point, looking at how that index performs.
Appreciate the clarification on that.
Yeah, good questions there, Brad. Other questions that you all may have?
Hey, Pat, I just typed it in, but I've got a couple of appointments this week, one tomorrow, one later in the week. I see I hear David's out now, so I was just trying to get some help with a couple of cases and some input and feedback on where to go with certain cases. And would you be available later?
Yes, I will. And so I just put my email out there. Unfortunately, I fat fingered a J on the end of the com there, but pat.schmidt@impactlegacygroup.com there, or feel free to Slack me. I'm willing to jump in. I know David is also, just so you know, he's not going to be 100% out, but he's got some things obviously that he's dealing with. But that guy is a phenomenal multitasker, so I know he's going to be jumping inside here. And but I've asked him to say, hey, make sure you're communicating with me. I know you have some things that you're already working on. But we got a team of folks here that want to be able to help you and make sure you can be able to focus your time with your family. So feel free if you want to email both of us and copy of us both on, or Slack us both. But we're here to help, man.
Thank you.
You bet. And likewise, as we wrap up here, just want to take a moment just to thank you all. But I know not everybody wants to ask maybe a question in this format, so I invite anything in the Slack channel. If there's something that comes up, maybe you scratch your head after sitting on this for another 15 minutes later today, or it could be anytime. As questions come up, just know that we're here. There's no such thing as a dumb question. There's no such thing as bringing a client concern or question or statement to us. We're here to help you. We want you to win. We want your clients to win. And if you win, your clients win, we win too. So we're thrilled to help. So please don't hesitate. There's no such thing as anybody ever being a burden to us. We want to help you. We want to support you. We want to make sure that we're helping coach you and helping you grow. But we also want to make sure that we're doing what's right with your clients. And so you're going to come across some complicated things. You see statements and, seeing things for the very first time. Some things just need a second set of eyeballs. That's wonderful. We're here. I also invite you, if you're at the client home or in your office and they have a question, try to dial us in. We're here. We may not always be available, but I will just tell you that you start using words like team, or we have a group that focuses and does these things, that just escalates your professionalism, shows your credibility. I know some people feel like, oh man, I need to be the master of all. You don't. People love to know that you have a team, that you have resources and people that you can bring into the fold to be able to help do what's best for them. So I appreciate you all. I hope you all have a wonderful week. Continue to win. If I don't see you or chat with you, have a Merry Christmas, and hope to see you all soon. Bye, everybody.
Thanks, Matt.